Passive income. We all love it. And we're going to talk about another method of obtaining it today on the Sub2Deals Show. Hey, Sub2ers, welcome to this episode of the Sub2Deals Show, where we talk about all things subject to. Now, occasionally we will talk about other real estate investing topics, but it's always something to help you with your real estate investing business. If you're listening to our podcast on Apple or Google or any of those other channels, we'd like to invite you to subscribe to our YouTube channel at sub2tv.com. We release new videos just about every single day. It's always something that will help you with your real estate investing. If you're interested in creative finance or subject to, you might want to check out our Sub2 University, where we have courses and training on all different types of investing, all creative finance, and it's always simple, easy to understand stuff. I'm not a very complicated guy, so if I'm teaching you, it's going to be simple to understand. And if you're on a budget and you still want to learn about creative finance, check out our $7 coaching. It is the least expensive coaching program you'll find on the planet, only $7 a month. If you find something less expensive, let me know about it because I want to get involved in that. Guys, today we're going to talk about something a little bit different than residential real estate. We're going to talk about self-storage investing and how you can buy these properties and create tons of passive income for yourself on a monthly basis. Our guest today, Fernando Angelucci. I got that right. I don't think I messed that up. Fernando is going to be here today. He is going to talk to us about self-storage investing. So welcome to the show, Fernando.
Thanks for having me, William.
Man, we were talking about this before we got started. My wife created a cheat sheet for me and everything else. And I said, man, I'm going to try my best not to butcher your name. You guys know I'm from the South. I'm not very smart. So I think we got Fernando's name right. But listen, welcome to the show. I know I read your bio, man. Absolutely amazing. I know you're going to tell us all about yourself, but I got to read this to everybody anyway.
Sure.
You worked for a Fortune 50 company, and at 23 left and started investing in real estate. I mean, to old timers like me, I didn't learn about real estate investing until I was almost 40 years old. But by the time you were 30, you had built a portfolio of over $150 million in self-storage assets. That's amazing. So tell everybody how you did that.
Yeah, so I was pretty lucky. So I was the son of two immigrants. They kind of gave me the old school American dream, right? Go to school, study real hard, get good grades, go get a job for 40 years, and retire with a pension. Unfortunately for them, when I was 16 years old, I read a book called Rich Dad, Poor Dad by Robert Kiyosaki, and it completely changed the way I viewed wealth and security in life. So from that point on, I wanted to do anything I could to get into the real estate space. And unfortunately, my father said, gave me the old Henry Ford, you can have any color as long as it's black. He said, you can get any degree as long as it ends in the words engineering, but you're going to have to go to school. So I said, okay. So all throughout college, I read every book I can get my hands on regarding real estate. Residential real estate is where I started, actually. And then graduated, worked for Dow Chemical, and within 13 months, already started doing real estate and quit my job. So the very first thing I started doing was wholesaling residential houses. And then from there, I started flipping residential houses and then buy and hold residential houses, including a lot of sub-2 strategies that I learned from people like yourself. And then from there, I started upgrading that into, small multifamily, large multifamily. Then 2016 came around, and I stupidly thought that the market was going to crash in 2018. Boy, was I wrong. So started selling off all of my investments, all my sub 2 deals, what have you, and bought my first self-storage facility in 2018. And from there, in the last 5 years or so, we actually just crossed over a little over $220 million in deals, many of which were actually done with sub 2 style financing, creative financing, which we can cover here shortly. So it does work regardless of the asset class. Still got a seller. The seller's got unique problems. You got unique answers. There's ways to make a win-win-win for everybody involved.
Hmm. Well, that sounds great. I know so many investors that have made a switch from residential to multifamily to commercial to other things. I've never felt the desire to do that. I don't know why, really. I just love residential real estate, dealing with people, buying houses, selling houses. We love to sell houses with seller financing. Why did you decide to make the switch?
So what I found out is that everything you do in the single family world, you can also do in the commercial world. It's the same thing, right? You can do buy and hold, you can do fix and flip, you can do sub 2 deals, you can sell with seller financing, you can do all that just on larger assets. And what I learned is as you add zeros onto deals, it actually gets easier and easier to do it. When I was trying to raise my first $50,000 to do a single family home, it was like pulling teeth. And then when I raised $500,000 to do my first self-storage deal, it was a little bit easier. And now I'm raising $5 million to $50 million to do storage deals, and it becomes easier and easier and easier. Not only on the equity side, but then also on the debt side. Getting a $150,000 loan or a $100,000 loan is very difficult. Same thing with working with a seller where that may be their only investment that they have, and that one investment is the difference between them having a good retirement or not, versus now I'm dealing with a seller pool that is much more financially capitalized. They're able to get a lot more creative on the deals that we're working on. And then same thing on the sell side. When I'm selling, now I'm selling to not people where this is the only asset they're buying. This may be one asset in a portfolio of $1 billion worth of portfolio, so that it's much easier to get the transactions done, especially on the seller finance side. There's a lot of investors that are shifting to the commercial side, especially self-storage side, because of what we've been talking about, and being able to sell my deals to them with seller financing, not only to help them in this pretty tough rate environment we've been seeing, but also help us get a really good deal as well and hold the note and create passive income for ourselves, because we're able to sell off that note and collect, a monthly paycheck in the mail without having to do any work. So that's pretty
Right.
great.
For sure. I know we talked before we came on here, and you've mentioned it since, that you can do all of these deals, even self-storage facilities, commercial stuff, with creative financing. How is the negotiation different? Is it different with, say, the owner of a self-storage facility than it is with Joe homeowner who needs to sell his house because he's in foreclosure or he's getting a divorce or whatever it may be?
Yeah, so there's a couple differences I've noticed. So number one, it's much harder to find, say, someone that's in distress, typical distress in the commercial world, especially in the self-storage world, because these assets cash flow pretty heavily. We're talking about 30% break-even occupancies if there's no leverage, 50 to 60% break-even occupancies if there's leverage. So it's less a conversation of, hey, how do we get you out of this tough situation in the next 30 days before you have a fire sale or some type of foreclosure sale, and more a conversation of, it's much slower. So instead of it taking a couple days to negotiate, you're looking over, 2-3 months. Everything moves a lot slower. And it's less of a, hey, you're in an issue versus hey, you're looking to retire, you want to travel, you want some cash, but still want some income in place as well. So the sellers we talk to are less distressed, but because they're less distressed, they're more open to doing very creative structures because they don't necessarily need all the cash today, right?
Right. Okay. I see what you mean. So, just in thinking about what you're saying, finding sellers in distress, and I think of all the ways that just as creative financiers, financial people, we do that, whether it's targeting people in foreclosure, divorce list, water shutoffs, I mean, whatever it may be. Is there a way that you target people for these assets that you want to start negotiating with?
Absolutely. So, typically our avatar is someone that's on their second or third retirement, let's call it. They retired from a job and then decided to get a self-storage facility. Now they're looking to travel again or, retire for good. They're typically someone that doesn't run the facility professionally. This is something more of a hobby. So there's a lot of meat on the bone still to do value add. Rents are typically not where they need to be compared to the competitors. The expenses are typically much higher than they need to be just because they don't have the scale or the professionalization of the softwares that we use. So what we like to do is, just in general, there's much less self-storage in the United States than there is single-family and multifamily homes. There's a lot of averages out there that range anywhere between 60 to 70,000 facilities in the entire country. So you can basically blanket all the facilities with a mail campaign that would cost you roughly the same to blanket a city that you're targeting for say, single-family home. And I've been on both sides, right? So I know how it goes on both sides. What we like to see is mom and pop owned facilities. So they own 2 or fewer facilities. They aren't professional owners. They typically own those facilities in their own names instead of an LLC, just like how you target single family homes, right? You don't want to go after the LLC owned stuff. You want to go after single family or the individually owned stuff. And then we look for things that are in areas where it can be improved. Population's growing. Their rents are not, up to where the market is. Their expenses are too high. So typically how we'll target these people, if you want to get super granular, we'll pull up a list that's either an SIC list or an NAICS list. And they have special codes that you can use. 531130 is one of the codes we use for the NAICS codes. And then we just send them letters, or we get their contact information. We skip trace it, and we give them calls or shoot them emails, whatever we can do to get in front of them. Driving for dollars is still a great avenue in this space, just because a lot of self-storage facilities in the United States are miscategorized or misclassified, so they may not show up on these lists. So if you're driving and you happen to see a self-storage facility that looks like it's not very modern or it's lacking some technology, there's a good chance that if you walk in, there's like a 50% chance that the person behind the counter is the owner, and you can talk to them, leave your card, what have you. So that's typically how we'll target these people. Another way that, nowadays, because all the podcasts we go on, about 30% to 40% of the deals we do are from people that hear us on podcasts. They do what I tell them to do. And then they say, I don't know what the next step is. Fernando, would you like to partner with me and show me how to do this? And we'll come in and take an equity position as a partner to basically handhold them through the process.
Right. Okay. So if someone listening to this is doing single family, or maybe they haven't even done a deal yet, but they're like, hey, this sounds like something that I might want to do, what would you recommend to them to be the first steps to take to get started in self-storage investing?
Yeah. Marketing, right? So that's the very first thing you want to get done is get that engine rolling. That's where you're going to start finding all your deals. But in addition, at the same time, start learning the space. All of our social media channels, if you go to ssse.com, they'll be on there. Or if you just follow me, Fernando Angelucci, we put out all of our education for free. We'll show you exactly what we're doing and how to target them, how to underwrite them, how to market for them, how to manage the properties, etc. So you want to be learning along the way as you're doing your marketing. Once you get to the point where you have a deal under contract, if you're ready to go on your own, go right for it. If you think you need somebody to kind of look over your shoulder, feel free to contact me. You can reach me at the website, or you can give me a call, what have you.
Mm-hmm. So you say a lot of these sellers are open to creative finance. I'm guessing the majority of them want cash. And in your estimation, probably 2/3 maybe, or even more, want a cash sale?
I would say that is the case, for recently with the massive increase in interest rates over a 1.5 year period. Those cash requests are just unreasonable. And we just spell it out to them very clearly. We say, listen, I'm willing to pay you this price that you thought you can get 18 months ago if you give me the terms from 18 months ago. Unfortunately, the banks today are giving me these terms, and in these terms, the max that the bank will let me pay is X, which is well below the price that you want. So you have kind of 2 or 3 options now. One is you can lower your price to allow for the debt service coverage that the bank's going to allow, or you can keep your price the same and you allow me to structure the terms that allows you to get the price you want but get the debt service coverage ratio that I need to eventually refinance this from underneath you. Or you can come in as a partner. And so we've started structuring deals where we bring sellers in as a JV partner, and that has allowed for some really creative things on our side with the amount of equity that's required when we close with a bank.
Yeah. You know, when I got started investing, I lived in Macon, Georgia, and I met another guy there that invested on the side. He was actually a pilot with the Air Force, and his reason for investing was purely for retirement. And he did some super creative things with self-storage facilities and with small mobile home parks where he would bring in private money to purchase the facility. And they were always distressed. They were exactly what you're talking about. They were mom and pop things that weren't updated, didn't have the latest technology. Rents were lower than they should have been. And he would bring in private money to buy the facility and get an option to purchase it at a slightly increased price, 4 or 5 years down the road. And he would spend all of that time bringing the rents up, bringing the facility up, adding storage spaces, adding things like parking RVs and boats and doing all of those things. And when he raised the value, he would exercise his option and put all of the money in his Roth IRA. So he didn't even need the money. This was such a powerful strategy. I've watched this guy put, $500,000 at a time in his IRA, all tax-free with just an initial contribution. So, I mean, those kinds of investments allow you to put such a large amount of money in there at one time, so much more than you can with a single family home. So yeah,
the option strategy is fantastic, especially if you're putting in a Roth. You pay, with a Roth, you pay your taxes up front, and then it grows tax free, and you take it out tax free once you retire. It's a great strategy. So we do something similar to that. However, I don't feel very comfortable improving someone else's property without ownership. And there, unfortunately, has been a lot of case law where people are able to get out of option contracts. So we won't do that for the whole facility, but we might do something like this, William, where we'll buy a subject facility, and there just happens to be 5 acres of land that the seller also owns next door. And I'll say, hey, let me put an option on that land because maybe they wouldn't give me the price that I need based on the comparable. Say, for example, I do a lot of deals in Georgia, North Carolina, South Carolina, Tennessee, areas that are growing really fast, and sellers think their land are worth $1 million an acre, but then when you pull up all the sales comps, they're worth $25,000 or $50,000 an acre, right? So when that happens, what we'll say is, okay, meet me somewhere in the middle. You don't want to take $50 an acre for it. I can't give you, $500 an acre, but what if we put a 5 or 7 year option on it? I'll pay you an option fee of $1,000 an acre, $5,000 an acre. And I'm able to purchase this additional land for, let's call it $200,000 an acre. And then when I go to sell 5 years down the line, I'm able to sell my facility with the option, the ability to assign my option to the new buyer. And that all of a sudden raises the value of my facility because now it's an expansion play. And now in that 5 to 7 years that I've held that facility, maybe the town has grown around it, and now it's an infill location, whereas before it was just raw land in a sea of raw land. You see what I'm saying? So that's one of the strategies that we've used on the option side. Another strategy that I'd love to talk to your listeners about is this joint venture structure. Again, let's talk about development, okay? So I buy facilities as small as $1 million, even smaller. The cheapest facility I bought was $225,000. I mean, really small in the self-storage world. I know that's pretty large for a house. And what we've done is we'll buy land to develop these Class A REIT grade, institutional grade assets. They're $15 million to build. buying 5 to 10 acres, and once it's all stabilized, it's worth 25 to 30 million bucks. But the problem is, because we're such good investors, you and I, and we're able to find good distressed deals off market, the unfortunate part is the appraiser says, well, why would anybody sell their land for something less than it's worth, right? We all run into this problem. And so what I figured out is, okay, in this time of, high interest rates or higher interest rates and larger down payment requirements, what if we never show that purchase price at all? So how do we do that? Well, we say, hey, Mr. Seller, I know you want to sell me this land for $500,000. I know it's worth $3 million. But if I buy it for $500,000, the appraiser is going to give me $500,000 worth of value, and I'm going to have to bring way more capital for the down payment. So instead of that, let's do this. Instead of me paying you $500,000, how about I structure it like this? Not only will I pay you an extra 20% on the value of your land, so instead of $500, I'm going to pay you $600, call it.
Right.
And on that $600, instead of before where you're going to pay, call it 20 to 30% capital gains on that value, what if I apply all of my bonus depreciation that I get through doing a cost segregation study to your sale? So that $600 is $600 net into your pocket. So now when you spell out all the math for them, you actually show them that you're giving them 50% more net cash in their pocket by coming in as a joint venture partner into your investment. But now look at the great side for us. Now, instead of me buying this land for $500,000 and putting up a $15 million project and still having to put $4.5 million in cash as a down payment, now I'm getting $3 million worth of equity on the land because there's been no transaction recorded in the last 48 months or so, right? So now instead of me raising $5 million, I only have to raise $2 million to get the deal done. Or if I go SBA route, I may not even have to raise any capital at all, and I can get into this deal with zero cash out of my pocket, which I know is a big Sub2, strategy. No cash out of pocket.
Right.
So we're actually doing this right now on a deal in North Carolina, where the investor or the seller's coming in as an investor. We're getting an 85% loan-to-cost loan from the Small Business Administration, the SBA, and all of the value in the land is going to allow me to not only not put down any type of down payment because all that equity is going to count towards that down payment, but it's also going to give me a little bit of working capital. So I'm actually going to get a little bit of bucks in the bank to pay for some things I need up front. So all in, I have no cash out of my pocket. And at the end of that deal, at the end of 5 or 6 years, I'm going to walk away with $3-4 million in profit.
That's great. Your creative finance is just so much more than lease options and subject to and all that. I mean, it's just that there's any way, if you've got a buyer and a seller and they can agree, you can structure this thing so many ways. That's better for everybody. It's just amazing, really, listening to
I learned from one of my my good friends, also in the Sub2 kind of seller finance space. I'm not sure if you're familiar with Eddie Speed, but Yep. So Eddie would always talk about having a talk off, right? Mm-hmm. Let's slow everything down. Let's have a talk off. So instead of trying to just get out there and just blanket them with offers, talk to them. Have that tactical empathy. What are their goals? What are their needs? What are the issues that they're facing? Is it that they need money for college, for their kid or grandkid? Okay, what are those tuition payments each year? Let's structure some type of financing plan that I can make those payments that coincide with the tuition. Maybe they don't need any of the cash up front, and you ask them, well, if I pay you all this money in cash, what are you going to do with the money? You're just going to put it in a savings account earning 1%? What if I can get you a 15% return using an investor strategy where I can get you a 6 or 7% return, using a seller finance strategy? So there's so many avenues that you can go in the creative financing space as long as you're willing to listen and truly listen to what the seller needs.
Yeah, for sure. I tell my students the deal is almost always in the seller's story. If you'll just listen to what they're saying, they will tell you what they need. And how you can do it.
That's exactly right.
I have a question for you. I told you, Jody and I have really been traveling for the last couple of years, just going from place to place. And one thing I've noticed is that you can drive through, let's say Kansas, miles and miles of nothing. And out in the middle of nowhere, there'll be a self-storage facility. And I always wondered, how do these people, they build it, do people really show up with stuff? Is there such a thing as a bad self-storage facility investment? And if there is,
Abs-
what do you look for?
Absolutely, right? That is just like any investment, every self storage investment can carry a certain degree of risk if you're not doing the proper underwriting. All right. So here's some just real quick, off the cuff, back the napkin things that you can use, real simple, to make sure the storage facility you're buying is a good facility. Okay. So the very first thing we need to realize about self-storage is that it is a very hyper-localized business. That means that typically the majority of your clients, your customers, are going to be coming from a 5 to a 20-minute drive time from your facility. That usually equates to 1 to 3 miles, maybe 1 to 5 miles. If you're more rural, maybe 1 to 10 miles. So in that trade area, go to all the competitor facilities and see what occupancy they're at. If they're all above 90% occupancy, that most likely signals that there's unmet demand in that market that the supply is not able to cover. Okay, so that's number one. Now, if all of a sudden you go to all those competitors and they're at 60%, 70% occupancy, probably not a good facility to get involved with unless you're really picking it up for just way, way below 50% of market value. Now, that's the kind of the back of the napkin math for something that's called the supply index number. Supply index number is the amount of net rentable square feet in the trade area divided by the population in that trade area. If it's below...
Is it just as simple as walking in and saying, what's your occupancy? I mean, it's got to be a little more to it than that.
No, I mean, believe it or not. Okay, let me tell you the breakdown of the industry. So you got about 18% of all the self-storage facilities in the nation are run by the 6 largest publicly traded REITs. The next 12% roughly are owned by the next 100 largest operators, which I'm a part of. Okay. Mm-hmm. That means that 70% or more of the facilities in the United States are owned by these mom and pop operators that are treating it as a hobby. They don't train their personnel to not give away these trade secrets. So I know you're saying it can't be that easy, but it truly is. I'll call up, if I'm not trying to be sneaky, I'll call up some companies and I'll say, hey, what's your occupancy looking like? You got any space for me? And they'll flat out tell me we're at 92% occupancy. All that we have left are this, and this unit. If they're a little bit more savvy, they were trained on, potentially these are competitors, you shouldn't be giving away this information. Then I do what's called secret shopping. I'll literally call them and say, hey, I'm a property flipper in the area. My business is getting big enough where I need to get a warehouse, but it doesn't really make sense for me to buy a warehouse just yet, or rent a warehouse. I'm going to need about, 10,000 square feet. I know your facilities, your units aren't that large. Do you got 10,000 square feet for me? If not, how much do you got? How big is your facility? And then you do the math that way, right? It's, there's ways to get around it. Now, if you come to one of my facilities and you start asking those types of questions, my managers will immediately shut you down and say, we have a 5x5 available for you, sir. A 10x10. How much space do you need? And if they try to pull the games that Fernando plays, where I want 10,000 square feet, and say, hey, we're not going to be your best customer. I can connect you with a industrial broker or industrial tenant rep that can find you some industrial size space, right? But it is truly that easy. It is that easy.
Okay. All right. So those are the tips. Find out the occupancy. And that'll give you an idea of if there's demand. I wonder how those guys do that, though, out in the middle of nowhere. Where do people just get in their mind, I think I'm going to build a self-storage facility out here, 50 miles from anything?
Yeah, so how the rural pieces will work, and I'll touch on that for a second, but I want to come back for one piece here. So not only is that competitor analysis very important, but then also at the same time, when you're secret shopping those competitors, also ask for what the rates are on their units. And if all of a sudden you see by a 10x10 at a competitor is at, that's 90% occupancy is $180, and the facility you're looking to buy a 10x10 is $100, there's a lot of room there to raise rates without having to put you don't have to put any dollars into the facility. And now you've already increased the value of your facility by 60-70% in one day, right? So how did these rural units start popping up? Well, a lot of people have farmland. And what ends up happening is people that live in town that don't have as much farmland will start talking to their friends that have farmland and say, hey, can I park a tractor trailer on your land, or can I park some ATVs in one of your machine sheds? And after a while, they say, hey, maybe I should just build a row or 2 or 3 rows of self-storage. And that's how it usually starts. And that's one of the reasons why there's a lot of opportunity in this space, is because a lot of those self-storage facilities, instead of being categorized on the property list that you buy as self-storage, they're categorized as farmland, because no one ever alerted these taxing agencies or these land classification agencies to change them. And then all of a sudden, they may have built it in the 80s, and that town over the last 50, 60 years has grown substantially, and now that town is starting to encompass where the self-storage facility is, where in the past it was just farmland. Those are great deals to buy. These are what I call like the Class C, Class D deals in the secondary and tertiary markets. You can make a ton of money off of those deals. I just sold a portfolio of 10 of those types of deals in June of 2022 that I acquired over 3 years, and we tripled our money on that portfolio.
Awesome. That's great. Listen, Fernando, for anybody else that wants to learn more about self-storage, they can visit your website, ssse.com, and get a bunch of information there. But they can also, this amazed me, you said, let's give everybody my phone number. So, guys, if you're listening to the podcast, the number is 630-408-8090. You can call or text, and that's your personal cell phone, isn't it?
It is. You can text me right now while you're listening to this. It'll pop up here. I'll respond here pretty quickly. What I've learned, and one of the things that's helped me in my real estate journey, is taking massive action. And I remember a lot of times listening to podcasts when I was learning things to do, and they'd send me to a website, and then there was a contact form, and then you got to fill out the contact form and hope somebody emails you back. There's no way to get in contact with somebody directly. I said, this is not a great way to do this. So if you guys want to take massive action, that is my personal cell phone number. You can text or call. Texting is the fastest way to get a hold of me, just because I'm in calls and podcasts all day. And I'll get back to you right away.
Okay. So again, 630-408-8090. Talk to Fernando directly. If you've got any self-storage deals, you want to learn more about what he does, and you'll JV with people that have deals.
Over 40% of the deals that we are currently doing in 2023 are joint venture deals with people that either have no experience in real estate whatsoever, and they found a really good deal, and they need us to do basically everything else, all the way up to guys that are super professionals, have $100 million multifamily or single-family mobile home park portfolio, but they just don't know a lot about the storage space, and they just need somebody to come in for those pieces that they're missing. So across the entire experience spectrum there.
Okay, awesome. Well, Fernando, thanks so much for joining us today and talking about self-storage. I've known people that have done it. I've never done it. I'm more of a single family guy, but I know a lot of investors out there who are interested in commercial, multifamily, that sort of thing. And I think they probably got a whole ton of value out of this today. So thanks so much.
I'm glad. If you guys want to go even more in depth, and if you'll have me, William, I'm always more than happy to do part 2 and part 3. I've done that with a lot of other podcasts, just because there's so much we can talk about on this subject, especially if you want to get really into the weeds.
Okay, well, let's do that. Let's come back and talk more about due diligence and all the real granular topics there in there. Okay, sounds great.
Absolutely.
Thanks so much. Okay, guys, that is it for this episode of the Sub2Deals Show. Check us out, our YouTube channel, sub2tv.com. We'd love to have you join us there. If you're listening to our podcast and not watching us on YouTube, give us a 5-star rating at Apple. It helps people find the podcast, and we would really, really appreciate it. So till the next episode, talk to some sellers and buy some houses.